Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Okay, so for this quarter's podcast, I thought it would be good to sit down and have a conversation again, given that we just released the quarterly letter about a week ago. Obviously, there's a lot of things going on in the market, through the first quarter. And so maybe if you want to, we can dive right into this big question I think that we're getting. And then, you've highlighted, over and over again that clients are asking, but it's this idea of interest rates are higher, short-term interest rates are higher, T-bill rates and GIC rates are now much more attractive than they were, in many, many years. And so, this idea or question about, T-bills are attractive, what should we do about it? Or how is Avenue thinking about this in context of, the overall portfolio management?
Yeah. And the other extremely important takeaway from that is the outlook, for the economy. And then subsequently the way people, generally think about the stock market. We're thinking about it the same way. And we've said we're defensive because the outlook isn't all that great. So just like going, well, shouldn't I just shift to the sidelines, and where you haven't had any rate of return in the T-bill market for such a long time, or in your bank account, think of that way, GIC, T-bill, whether it's 3 months to a year, you can actually get a rate of return. And so I think we'll touch on, work our way from the front end of the risk curve to why we're still in a corporate bond portfolio, and then why we, where we're seeing opportunities in the stock market, and why when times are actually kind of negative, you actually turn your attention to the stock market because that's where you're actually going to get deals. And I think we've finished up on where we're finding. Yeah. There's a teaser for why you're going to listen to the end of this.
No, it's okay, so teaser.
I'll just start on my piece because I think your side of the argument has been great, but I'll just touch on always when you're building, a portfolio, whether it's retirement, long-term money, certainly when you need to draw on your account every day, short term, whether we would even say whether the next year, have that in the bank ready to go, whether you spend $100,000 a year, whether you spend $150,000 a year, that kind of thing, having the bank ready to go. The temptation not to do that for the last decade, the stock market crash when the first time they really dropped interest rates.
Yeah,
so we've
almost 20 years.
20 years where the bank account doesn't give you a rate of return. So, hey, why don't we just stick it in, in an investment security? And so always that means is that you're going up the risk curve. And this is what's happened. We've got 20 years of psychology where historically always there is a short-term strategy of saying, here's my money, park it in the bank, make sure it's there. Next, what am I going to invest? This is my 2 to 5 year time horizon, maybe even, and with compounding, that's a 7-year time horizon, which we've talked to anybody, if you're living off your investment wealth, that's when we can look at a bond investment. And we would then always argue, and I think this is, we're going to have a dedicated call. This is such an important topic. Have Paul Gardner, touch on this with Matt and drive home this point. It's just like, why is that the right time frame? And then we can get compounding from the bond market. And we would say, as Canadians, that unique situation is having a Canadian corporate bond portfolio. Then when you're actually a long-term investor, 7 years and beyond, that's when you're looking at these high quality companies to compound, and that hasn't changed. Anyway, you've got another take on the T-bill argument, and just very specifically about short-term volatility.
Yeah, I think the other interesting thing, I think, and I can concede this, this feeling of uncertainty with the economic environment, inflation and recession, what's happening, all of that. And so that is causing this angst, which is then leading to, understandably so, why short-term interest rates or GIC rates or bank deposit rates at 3, 4, 5% look very attractive in a very uncertain world, especially over the short term. And my only sort of counter nuance point to that I would say, at the end of the day, I think the understanding, how we would approach this is saying, just because of debt levels out there, the level of or the degree to which governments are intervening in the economy, and to keep the debt manageable, there is a debasement of the currency that has to happen over time. And so, although being in short-term GICs or T-bills, it feels super safe today, over a multi-year or even over a 10-year period, I mean, it's a guaranteed way to lose your purchasing power, as our view would be that we think inflation is going to continue to be high. I think we've highlighted this in sort of previous letters. I think the uncertainty is around the path of inflation. So inflation has peaked. It is now rolling over, into a recession. Inflation will come down. Where inflation troughs is uncertain. I mean, there's a deflationary argument here too about, what the next 12 to 18 months look like. But then on the other side of that, I think the inflation argument will come back again, because you're going to have more stimulus and that will lead to more inflation. And so it's just thinking through, going back to, and you highlighted this, just saying, what are we trying to achieve, or what is someone individually trying to achieve being in T-bills? And it might feel safest today and next week and next month, but just know that it's not going to be a solution for a retirement over 10 or 20 years, because that money is going to lose its purchasing power, which is like, the Buffett quote is always, the most risky investment over 30 years would be to buy the 30-year bond today and hold it to maturity. Whereas equities are riskiest today, but equities in a 30-year view are actually, far safer, because if you own good businesses and good companies, I mean, quality companies are the best inflation hedge, because companies grow their profits through an inflation environment. And over 30 years, companies will be able to maintain purchasing power much better than a T-bill. So it's just trying to balance that. There's that feeling about today and the uncertainty, which we can certainly appreciate and empathize with, but it's then just tying it back to saying, what is the long-term objective? And just understand the risk of saying, a T-bill purchase today is not a solution for 10 years, because you're going to get your purchasing power debased. So that's the only counterpoint.
I think I would just really hit absolute practical numbers, and what, that I was 10,000 feet. I think you brought it down to 2,000 feet. And if we bring it right down to ground level, exactly in a very short term, government bond, which, treasury, everything, you call it government bond is anything north of anything longer than 2 years. Under 2 years, it's just a name. It's called a treasury bill. T-bill. So if interest rates right now in the T-bill market, and we've been seeing call it 4.5%, the risk is, and we still say that if and we're going to get into the topic of why the economy is this slow motion slowdown, and you're going to hit, there's a negative and then a positive argument we want to hit next. But in a year's time, we're speaking April next year, there's a scenario that short-term interest rates are back down 2%. So you captured that 4.5% for last year, but then you're reinvesting at 2%.
Yeah.
Whereas again, and I showed that structure of, if you have a longer time horizon, we're looking at the bond market saying we're investing in corporate bonds, getting our 4 or 5% of corporate bonds, but we've laddered it out for 3-4 years. It's literally that small of a time frame and an argument. And we're saying that there's a scenario that interest rates are still 4 to 5% this time next year, but there's also a high probability that they're lower.
Yeah.
So going in, and you're touching on the point, which is going to the sidelines, coming back in again, market timing, the amount of volatility is it's very hard for us to get timing right. We might time it right twice perfectly, and the third time we don't time it right. And the other way to do it is just have a strategy that we can consistently execute and ride through the middle. And but I'll segue into our topic for saying we actually, our overall portfolio in the first half of the year, we're up a little bit. But the extraordinary thing is it's actually quite stable. And the market, if you're talking about commodities, currencies, individual stocks have not been stable at all.
Yeah.
And we're actually trying to build stability. And so we actually feel quite successful, even though it's great to try to hit it out of the park. We're more concerned about saying, do we have a stable portfolio of high quality companies that we can compound our way out of this, as opposed to tech stocks that were down 80% last year. That's great. They're up 20% this year, but you're trying to eliminate the wild ride that then knocks us out of being a long-term investor.
Yeah.
So anyway, I'll just segue right in, because make sure we hit this, and there's so much going on. This could be a 2-hour conversation. So I just want to go right into, this we phrased it in the quarterly letter, the slow motion slowdown. And the extraordinary thing, we even had a bank credit event already. And by the end of the weekend, it was almost sort of gone. But Bryden, you've done some great work on this in slides. And I think we're going to show one slide, but really define your argument of where we are economically. And again, why we are positioned defensively right now.
Yeah, the way I would say that is that, we've been talking about this, it seems like for a long time, like even going back to a year, but I would say that with all of the data that is now coming out, we are as close to being like in a recession as you can possibly be without it being sort of blatantly obvious to everyone. And there's this element where I think the market and just in general, people are still fighting that, okay, it's going to be okay. It's going to be okay. But if you look at, for example, the one that we like to look at is the leading economic indicators is now clearly, down almost 8% year over year, which is clearly in recessionary territory. The job market has not fully broken yet, but that's always the last thing to break. And then once it does, you're in recession. So for all intents and purposes, I would say today, April 2023, in 12 months time, we will look back on today and say we were in recession then. But at the same time, it doesn't